Hey everyone. The expectation of upcoming rate cuts by the Federal Reserve and the prospect of falling interest rates once again raises the question of whether cap rates will go down. A lot of investors believe that interest rates strongly influence cap rates, and to a degree there is a correlation. When we ran a regression analysis between the 10-year Treasury and cap rates, we found a 40% correlation, which basically says they move together to a limited degree. But if you look back over time, there are many instances when the 10-year Treasury was rising while cap rates were falling. And there are many instances when the Treasury rates were falling and the cap rates were rising. Just look at apartment cap rates relative to the 10-year. You can see many instances where they were moving in opposite directions. Treasury rates spiked in 1994 as cap rates were trending lower. It happened again in 1996. And from 2002 through 2006, the 10-year Treasury was rising slowly as cap rates steadily fell. Then from 2006 to 2008, Treasury rates fell as cap rates went up. Now, although I'm demonstrating the trends using apartment data, the movements are pretty much the same for office, retail, and industrial. Again, there is some correlation. Over the last 30 years, the 10-year Treasury has generally been trending lower, and the same is true for cap rates. But there are no clear signs of any real cause and effect between Treasury rates and cap rates. Now, I did find something that did have a strong 78% correlation to cap rates, and that was transaction velocity. It's an inverse relationship. When more deals were being done, cap rates went down, and as transaction velocity slowed, cap rates went up. That trend pretty much held true for apartments, retail, office, and industrial properties. Again, looking at how that played out for apartments, there's a clear trend from 2002 through 2006 where transaction flow was climbing and cap rates were falling. Then in 2007 through 2010, transaction count fell and cap rates rose. You can also see the spike of activity in 2021 and 2022 and the correlated cap rate decline during that cycle. Then in 2023 and 2024, as transactions fell, cap rates went up. And a key thing to pay attention to here is that transaction velocity is starting to climb again. Now, you might wonder if investor activity is being driven by the interest rates, and we looked into that. Once again, there was a correlation, but it's small. There was only a 30% correlation between interest rate movement and transaction activity. And that's after the data was time shifted to account for a 60-day lag between interest rates and deals closing. So while interest rates influence commercial real estate sales activity and in turn cap rates, the correlation hasn't historically been that strong. Now, in the current climate, where interest rates were a big factor in slowing investor activity in 2023 and 2024, if interest rates fall in the coming months, it could spur a significant wave of capital to re-enter the commercial real estate investment market, especially when it's coupled with the new tax rules allowing 100% bonus depreciation on qualifying components of a new commercial real estate acquisition. And a wave of capital entering the market could suggest that cap rates would begin to taper. But it will take time. There will be a lag between the movement of capital and the movement of cap rates. So looking forward, the probability of increased transaction flow is rising. There are a lot of forces aligning in that direction. Many investors have been on the sidelines for an extended period, and there's a lot of pent-up capital waiting to deploy. In addition, the volume of mortgage maturities that are coming due is elevated. The tax benefits under the new rules also adds to the momentum, and if interest rates do come down, that could be the tipping point. But even if interest rates don't decline, I still believe that investors will be increasingly active in the latter part of 2025 and into 2026. Within that context, I once again suggest that investors take a hard look at their portfolios and identify any assets they want to prune. Then that capital can be redeployed into properties and markets that may offer stronger returns. But remember, these trends will take time to fully materialize, and the investors who get ahead of the curve could benefit most. Which is why I always say investors need to keep their eyes on the horizon.